All right, let's talk about Warner Brothers Discovery, shall we? Of course, the company, as we told you on May 8th, it was, I think, the first time I'd sort of said the split was imminent. And, well, I'm not sure you want to define imminent, but they announced it this morning. They're splitting in two. You can see the reaction. We'll see what the stock does when it opens about 25 minutes from now. Two companies, again, as expected. There are a few things, though, that were not necessarily anticipated, and I'll get to them in a minute. But as for what you're going to be looking at if you're a Warner Brothers Discovery shareholder, well, you're going to get one share of a streaming and studios business comprised of Warner Brothers, their television, of course, and motion picture group. They're number one in terms of studio, in terms of TV. You also get HBO as a part of that, and you get the streaming service, HBO Max, most likely to become HBO at some point once they finally get rid of Max. You know, who needs Max? Global networks, sports, news, television brands, obviously all of the big cable networks. People know whether it's CNN, TNT, all the Discovery networks as well. You get over the air in Europe. A lot of sports there, here as well. Sports rights all will be with TNT. They've got that big market, I know, but it's worth a lot actually in Poland as well. Bleacher Report. So it's a split. And the question will be, of course, how's the market going to account for it? Is it going to accord a far higher multiple to the growth engine, namely streaming and the studio, which will have very little debt, is what I'm told, and what they're sort of forecasting of the $34 billion in total debt at the company, most of which will go to where the cash flow producing assets are, namely the global networks business. Currently levered overall, the company about 3.8 times. And this has been, guys, we've sat here. Let's look at 3 years. It's over 3 years since they closed the deal. It's 4 years since it was announced. And it hasn't worked. It hasn't worked. And in part because the decline of linear cable networks has been even worse than many of the pessimists might have imagined. And the cash flows associated with it have continued to go down. And when you have a large debt load, the investor base is simply going to be worried. And in this case, they were. Now, to that point, there is a component of this deal that was not necessarily something we had forecast, which is a very large tender that is going to be available to debt holders. They're going to borrow $17.5 billion in a bridge facility from J.P. Morgan. It will be replaced at some point when this is completed by a secured debt facility. But they're going to go out and make a bid for a lot of their debt. John Malone makes him very happy. Of course, he's been talking about this. A lot of it trades at significant discounts to its face value. They're going to offer it the same spread it was issued. And the hope is that a lot of debt holders are going to line up here, and you're going to be able to reduce your overall indebtedness by, it could be $3-4 billion overall dollars. That's significant when it comes to interest costs, when it comes to leverage, when it comes to a lot of things. And it's kind of coercive in part because, well, if you don't do it, if you aren't part of it, we're going to be getting a big secured facility that's going to be above you in the capital structure. You probably want to do this. So they're hoping and expecting that. If it doesn't happen, I'm still told they feel they are completely in the clear legally to do this, that the bondholders are not going to be able to jam them up. But we'll see. They'd rather that was not the case. Zaslav's going to run streaming and studios. Gunnar Wiedenfels, the current CFO of the company, going to run the company that's going to look a lot more like our future company, Versant, although a lot bigger.
A scale.
Yeah, it has more scale when it comes to cable. And obviously, as I said, over the air in Europe, a number of other businesses. But we've been talking about the declining cash flows here for a long time, Jim. And one question I think is, from investors is, why now? Now, Zaslav would say, because we weren't ready. We had to get streaming ready. We had to cut costs. We had to do a lot of different things. Now is the right time. But others might say, couldn't it have been a year ago? Why is this the right approach?
Would J.P. Morgan give them that bridge loan a year ago?
I don't know. I think so. They got downgraded to junk recently.
Yeah, I know. But, David, Zaslav you have to tell people about this is a man with big ambitions who I think would like to put together the largest category winner.
Yes.
Is that not true?
Listen, when you look at both of these companies, the question will immediately be, all right, what consolidation opportunities are available to them? Right. I think streaming and studio, that business, certainly you could see the possibility of a Paramount streaming business or the Peacock business of NBC Universal. Do they want to be a part of this in some way? I don't know the answer, but that will certainly be part of the conjecture. Or is it possible that an Apple or an Amazon or a YouTube would ever want to just step up and say, we'll buy it all? Now, by the way, on that front, you get into regulatory questions,
Right.
too. And this is down the road.
But if you put
this
together,
deal has got no regulatory issues whatsoever.
But if you put together a couple
split.
cable outlets so that the content is king, does that work?
I don't know.